Given a business scenario involving risk and return, the graduate describes ways to reduce an organization's risk in order to achieve long-term financial goals. Upon completion of this module, you will be able to describe how risk and return relate to each other, describe different types of risk, identify different ways to calculate return, identify ways to reduce risk. Video. Risk and Reward Introduction. View Risk and Reward Introduction video from Khan Academy. This video explains the basic concepts of risk and reward. Describe how risk and return relate to each other. The risk/return trade-off. Defining risk and return, the higher the risk undertaken, the more ample the expected return, and conversely, the lower the risk, the more modest the expected return. Key points: the general progression in the risk-return spectrum is short-term debt, long-term debt, property, high-yield debt, and equity. When a firm makes a capital budgeting decision, they will wish, as a bare minimum, to recover enough to pay the increased cost of goods due to inflation. Risk aversion is a concept based on the behavior of firms and investors while exposed to uncertainty to attempt to reduce that uncertainty. Beta is a measure firms can use in order to determine an investment's return sensitivity in relation to overall market risk. Key terms: inflation, an increase in the general level of prices or in the cost of living. Political risk, the potential loss for a company due to non-market factors as macroeconomic and social policies. Systematic risk, the risk associated with an asset that is correlated with the risk of asset markets generally, often measured as its beta. Risk and return considerations. Risk refers to the variability of possible returns associated with a given investment. Risk, along with the return, is a major consideration in capital budgeting decisions. The firm must compare the expected return from a given investment with the risk associated with it. Higher levels of return are required to compensate for increased levels of risk. In other words, the higher the risk undertaken, the more ample the return, and conversely, the lower the risk, the more modest the return. This risk and return trade-off is also known as the risk-return spectrum. There are various classes of possible investments, each with their own positions on the overall risk-return spectrum. The general progression is short-term debt, long-term debt, property, high-yield debt, and equity. The existence of risk causes the need to incur a number of expenses. For example, the more risky the investment, the more time and effort is usually required to obtain information about it and monitor its progress. Moreover, the importance of a loss of X amount of value can be greater than the importance of a gain of X amount of value. So a riskier investment will attract a higher risk premium even if the forecast return is the same as upon a less risky investment. Risk is therefore something that must be compensated for, and the more risk, the more compensation is required. When a firm makes a capital budgeting decision, they will wish, as a bare minimum, to recover enough to pay the increased cost of investment due to inflation. Thus, inflation is a pivotal input in a firm's cost of capital. However, since interest rates are set by the market, it happens frequently that they are insufficient to compensate for inflation. Inflation is a rise in the general level of prices of goods and services in an economy over a period of time. Risk aversion also plays an important role in determining a firm's required return on an investment. Risk aversion is a concept based on the behavior of firms and investors while exposed to uncertainty to attempt to reduce that uncertainty. Risk aversion is the reluctance to accept a bargain with an uncertain payoff rather than another bargain with a more certain, but possibly lower expected payoff. For example, a risk-averse investor might choose to put his or her money into a bank account with a low but guaranteed interest rate, rather than into a stock that may have high expected returns, but also involves a chance of losing value. Risk aversion can be thought of as having three levels: risk-averse or risk-avoiding, risk-neutral, risk-loving, or risk-seeking. Beta is a measure firms can use in order to determine an investment's return sensitivity in relation to overall market risk. Beta describes the correlated volatility of an asset in relation to the volatility of the benchmark that said asset is being compared to. This benchmark is generally the overall financial market and is often estimated via the use of representative indices, such as the S&P 500. Beta is also referred to as financial elasticity or correlated relative volatility, and can be referred to as a measure of the sensitivity of the asset's returns to market returns, its non-diversifiable risk, its systematic risk, or market risk. Higher beta investments tend to be more volatile and therefore riskier, but provide the potential for higher returns. Lower beta investments pose less risk, but generally offer lower returns. Describe different types of risk. Defining risk, there are many types of financial risk, including asset-backed, prepayment, interest rate, credit, liquidity, market, operational, foreign, and model risk. Key points: financial risk is associated to the chances that an investor might lose value in an investment. It is separated into different sources of decline. Often the risks interact with each other, and ultimately, shock causes panic. Many of the worst market crashes have been a result of widespread speculation and not the devaluation of that asset itself. In the market crash of 2008, investors feared that some homeowners would default. It triggered a chain of events that shocked the whole world and left many people in bad financial situations. Key terms: variable rate mortgage, a variable rate mortgage, adjustable rate mortgage, ARM, or tracker mortgage is a mortgage loan with the interest rate on the note periodically adjusted based on an index which reflects the cost to the lender of borrowing on the credit markets. Risk, what it means in investing, how to measure and manage it. What is risk? Risk is defined in financial terms as the chance that an outcome or investment's actual gains will differ from an expected outcome or return. Risk includes the possibility of losing some or all of an original investment. Quantifiably, risk is usually assessed by considering historical behaviors and outcomes. In finance, standard deviation is a common metric associated with risk. Standard deviation provides a measure of the volatility of asset prices in comparison to their historical averages in a given time frame. Overall, it is possible and prudent to manage investing risks by understanding the basics of risk and how it is measured. Learning the risks that can apply to different scenarios and some of the ways to manage them holistically will help all types of investors and business managers to avoid unnecessary and costly losses. Risk takes on many forms, but is broadly categorized as the chance an outcome or investment's actual gain will differ from the expected outcome or return. Risk includes the possibility of losing some or all of an investment. There are several types of risk and several ways to quantify risk for analytical assessments. Risk can be reduced using diversification and hedging strategies. The basics of risk: everyone is exposed to some type of risk every day. Whether it's from driving, walking down the street, investing, capital planning, or something else. An investor's personality, lifestyle, and age are some of the top factors to consider for individual investment management and risk purposes. Each investor has a unique risk profile that determines their willingness and ability to withstand risk. In general, as investment risks rise, investors expect higher returns to compensate for taking those risks. A fundamental idea in finance is the relationship between risk and return. The greater the amount of risk an investor is willing to take, the greater the potential return. Risks can come in various ways, and investors need to be compensated for taking on additional risk. For example, a U.S. Treasury bond is considered one of the safest investments, and when compared to a corporate bond, provides a lower rate of return. A corporation is much more likely to go bankrupt than the U.S. government. Because the default risk of investing in a corporate bond is higher, investors are offered a higher rate of return. Quantifiably, the risk is usually assessed by considering historical behaviors and outcomes. In finance, standard deviation is a common metric associated with risk. Standard deviation provides a measure of the volatility of a value in comparison to its historical average. A high standard deviation indicates a lot of value volatility and therefore a high degree of risk. Individuals, financial advisors, and companies can all develop risk management strategies to help manage risks associated with their investments and business activities. Academically, there are several theories, metrics, and strategies that have been identified to measure, analyze, and manage risks. Some of these include standard deviation, beta, value at risk, VAR, and the capital asset pricing model, CAPM. Measuring and quantifying risk often allow investors, traders, and business managers to hedge some risks away by using various strategies including diversification and derivative positions. Riskless securities. While it is true that no investment is fully free of all possible risks, certain securities have so little practical risk that they are considered risk-free or riskless. Riskless securities often form a baseline for analyzing and measuring risk. These types of investments offer an expected rate of return with very little or no risk. Oftentimes, all types of investors will look to these securities for preserving emergency savings or for holding assets that need to be immediately accessible. Examples of riskless investments and securities include certificates of deposits, CDs, government money market accounts, and U.S. Treasury bills. The 30-day U.S. Treasury bill is generally viewed as the baseline, risk-free security for financial modeling. It is backed by the full faith and credit of the U.S. government, and given its relatively short maturity date, has minimal interest rate exposure. While savings accounts and CDs are riskless in the sense that their value cannot go down, bank failures can result in losses. The FDIC only insures up to $250,000 per depositor per bank, so any amount above that limit is exposed to the risk of bank failure. While U.S. government bonds are often cited as riskless, investors can lose money if the government defaults on its debt. The U.S. came close to defaulting on its debt in 2011, when a political standoff over the debt ceiling led to a downgrade of its credit rating by Standard & Poor's. The episode caused significant volatility and uncertainty in financial markets and reduced economic growth. A looming default in 2023 would likely be worse, given the higher level of overall debt and the more polarized political environment. Risk and time horizon, and liquidity of investments is often a key factor influencing risk assessment and risk management. If an investor needs funds to be immediately accessible, they are less likely to invest in high-risk investments or investments that cannot be immediately liquidated, and more likely to place their money in riskless securities. Time horizons will also be an important factor for individual investment portfolios. Younger investors with longer time horizons to retirement may be willing to invest in higher risk investments with higher potential returns. Older investors would have a different risk tolerance, since they will need funds to be more readily available. Types of financial risk. Every saving and investment action involves different risks and returns. In general, financial theory classifies investment risks affecting asset values into two categories: systematic risk and unsystematic risk. Broadly speaking, investors are exposed to both systematic and unsystematic risks. Systematic risks, also known as market risks, are risks that can affect an entire economic market overall or a large percentage of the total market. Market risk is the risk of losing investments due to factors, such as political risk and macroeconomic risk, that affect the performance of the overall market. Market risk cannot be easily mitigated through portfolio diversification. Other common types of systematic risk can include interest rate risk, inflation risk, currency risk, liquidity risk, country risk, and sociopolitical risk. Unsystematic risk, also known as specific risk or idiosyncratic risk, is a category of risk that only affects an industry or a particular company. Unsystematic risk is the risk of losing an investment due to company or industry-specific hazard. Examples include a change in management, a product recall, a regulatory change that could drive down company sales, and a new competitor in the marketplace with the potential to take away market share from a company. Investors often use diversification to manage unsystematic risk by investing in a variety of assets. In addition to the broad systematic and unsystematic risks, there are several specific types of risk, including business risk. Business risk refers to the basic viability of a business, the question of whether a company will be able to make sufficient sales and generate sufficient revenues to cover its operational expenses and turn a profit. While financial risk is concerned with the costs of financing, business risk is concerned with all the other expenses a business must cover to remain operational and functioning. These expenses include salaries, production costs, facility rent, office and administrative expenses. The level of a company's business risk is influenced by factors such as the cost of goods, profit margins, competition, and the overall level of demand for the products or services that it sells. Operational risk is a type of business risk that arises from the day-to-day operation of a business and can include risks associated with system failures, human errors, fraud, or other internal processes that might negatively impact a business's financial performance. Operational risks can be managed through effective internal controls, processes, and systems. Businesses and investments can also be exposed to legal risks stemming from changes in laws, regulations, or legal disputes. Legal and regulatory risks can be managed through compliance programs, monitoring changes in regulations, and seeking legal advice as needed. Credit or default risk. Credit risk is the risk that a borrower will be unable to pay the contractual interest or principal on its debt obligations. This type of risk is particularly concerning to investors who hold bonds in their portfolios. Government bonds, especially those issued by the federal government, have the least amount of default risk, and as such, the lowest returns. Corporate bonds, on the other hand, tend to have the highest amount of default risk, but also higher interest rates. Bonds with a lower chance of default are considered investment grade, while bonds with higher chances are considered high yield or junk bonds. Investors can use bond rating agencies, such as Standard & Poor's, Fitch, and Moody's, to determine which bonds are investment grade and which are junk. Country risk. Country risk refers to the risk that a country won't be able to honor its financial commitments. When a country defaults on its obligations, it can harm the performance of all other financial instruments in that country, as well as other countries it has relations with. Country risk applies to stocks, bonds, mutual funds, auctions, and futures that are issued within a particular country. This type of risk is most often seen in emerging markets or countries that have a severe deficit. Foreign exchange risk. When investing in foreign countries, it's important to consider the fact that currency exchange rates can change the price of the asset as well. Foreign exchange risk, or exchange rate risk, applies to all financial instruments that are in a currency other than your domestic currency. As an example, if you live in the U.S. and invest in a Canadian stock in Canadian dollars, even if the share value appreciates, you may lose money if the Canadian dollar depreciates in relation to the U.S. dollar. Interest rate risk. Interest rate risk is the risk that an investment's value will change due to a change in the absolute level of interest rates, the spread between two rates, in the shape of the yield curve, or in any other interest rate relationship. This type of risk affects the value of bonds more directly than stocks and is a significant risk to all bondholders. Financial Industry Regulatory Authority. Investment risk. Explained. As interest rates rise, bond prices in the secondary market fall, and vice versa. Reinvestment risk is related to interest rate risk. It is the possibility that an investor may not be able to reinvest the cash flows received from an investment, such as interest or dividends, at the same rate of return as the original investment. Reinvestment risk is particularly relevant for fixed income investments like bonds, where interest rates may change over time. Investors can manage reinvestment risk by laddering their investments, diversifying their portfolio, or considering investments with different maturity dates. Political risk. Political risk is the risk an investment's returns could suffer because of political instability or changes in a country. This type of risk can stem from a change in government, legislative bodies, other foreign policymakers, or military control. Also known as geopolitical risk, The risk becomes more of a factor as an investment's time horizon gets longer. Counterparty risk is the likelihood or probability that one of those involved in a transaction might default on its contractual obligation. Counterparty risk can exist in credit, investment, and trading transactions, especially for those occurring in over-the-counter OTC markets. Financial investment products such as stocks, options, bonds, and derivatives carry counterparty risk. Liquidity risk is associated with an investor's ability to transact their investment for cash. Typically, investors will require some premium for illiquid assets, which compensates them for holding securities over time that cannot be easily liquidated. Model risk. This type of risk arises from the use of financial models to make investment decisions, evaluate risks, or price financial instruments. Model risk can occur if the model is based on incorrect assumptions, data, or methodologies, leading to inaccurate predictions and potentially adverse financial consequences. Model risk can be managed by validating and periodically reviewing financial models, as well as using multiple models to cross-check predictions and outcomes. Risk versus reward. The risk-return trade-off is the balance between the desire for the lowest possible risk and the highest possible returns. In general, low levels of risk are associated with low potential returns, and high levels of risk are associated with high potential returns. Each investor must decide how much risk they're willing and able to accept for a desired return. This will be based on factors such as age, income, investment goals, liquidity needs, time horizon, and personality. The following chart shows a visual representation of the risk/return trade-off for investing, where a higher standard deviation means a higher level or risk, as well as a higher potential return. It's important to keep in mind that higher risk doesn't automatically equate to higher returns. The risk-return trade-off only indicates that higher risk investments have the possibility of higher returns, but there are no guarantees. On the lower risk side of the spectrum is the risk-free rate of return, the theoretical rate of return of an investment with zero risk. It represents the interest you would expect from an absolutely risk-free investment over a specific period of time. In theory, the risk-free rate of return is the minimum return you would expect for any investment because you wouldn't accept additional risk unless the potential rate of return is greater than the risk-free rate. Risk and diversification. The most basic and effective strategy for minimizing risk is diversification. Diversification is based heavily on the concepts of correlation and risk. A well-diversified portfolio will consist of different types of securities from diverse industries that have varying degrees of risk and correlation with each other's returns. While most investment professionals agree that diversification can't guarantee against a loss, it is the most important component to helping an investor reach long-range financial goals, while minimizing risk. There are several ways to plan for and ensure adequate diversification, including spread your portfolio among many different investment vehicles, including cash, stocks, bonds, mutual funds, ETFs, and other funds. Look for assets whose returns haven't historically moved in the same direction and to the same degree. That way, if part of your portfolio is declining, the rest may still be growing. Stay diversified within each type of investment. Include securities that vary by sector, industry, region, and market capitalization. It's also a good idea to mix styles too, such as growth, income, and value. The same goes for bonds. Consider varying maturities and credit qualities. Include securities that vary in risk. You're not restricted to picking only blue-chip stocks. In fact, the opposite is true. Picking different investments with different rates of return will ensure that large gains offset losses in other areas. Keep in mind that portfolio diversification is not a one-time task. Investors and businesses perform regular checkups or rebalancing to make sure their portfolios have a risk level that's consistent with their financial strategy and goals. Can portfolio diversification protect against risks? Portfolio diversification is an effective strategy used to manage unsystematic risks, risks specific to individual companies or industries. However, it cannot protect against systematic risks, risks that affect the entire market or a large portion of it. Systematic risks, such as interest rate risk, inflation risk, and currency risk, cannot be eliminated through diversification alone. However, investors can still mitigate the impact of these risks by considering other strategies like hedging, investing in assets that are less correlated with the systematic risks, or adjusting the investment time horizon. How does investor psychology impact risk-taking and investment decisions? Investor psychology plays a significant role in risk-taking and investment decisions. Individual investors' perception of risk, personal experiences, cognitive biases, and emotional reactions can influence their investment choices. For instance, behavioral economics identifies loss aversion, a cognitive bias where people are more sensitive to potential losses than gains, can make investors overly cautious and avoid riskier investments that might offer higher potential returns. Understanding one's own psychological tendencies and biases can help investors make more informed and rational decisions about their risk tolerance and investment strategies. How do black swan events relate to risk management, and how can investors prepare for them? Black swan events are rare, unpredictable, and high-impact occurrences that can have significant consequences on financial markets and investments. Due to their unexpected nature, traditional risk management models and strategies may not adequately account for these events. To prepare for black swan events, investors can consider implementing stress testing, scenario analysis, or other techniques that focus on assessing the portfolio's resilience under extreme market conditions. Additionally, maintaining a well-diversified portfolio, holding adequate cash reserves, and being adaptable to evolving market conditions can help investors better navigate the potential fallout from black swan events. The bottom line, we all face risks every day, whether we're driving to work, surfing a 60-foot wave, investing, or managing a business. In the financial world, risk refers to the chance that an investment's actual return will differ from what is expected, the possibility that an investment won't do as well as you'd like, or that you'll end up losing money. The most effective way to manage investing risk is through regular risk assessment and diversification. Although diversification won't ensure gains or guarantee against losses, it does provide the potential to improve returns based on your goals and target level of risk. Finding the right balance between risk and return helps investors and business managers achieve their financial goals through investments that they can be most comfortable with. Types of financial risk. The term financial risk is broad, but can be broken down into different categories to understand it better. Asset-backed risk affects investments in asset-backed securities such as home loans. In order to finance home sales, banks issue bonds that serve as a debt obligation to its buyer. The buyer of the debt is essentially receiving the interest from the bank that the home buyer is paying to it. Prepayment risk is the risk that the buyer goes ahead and pays off the mortgage. Therefore, the buyer of the bond loses the right to the buyer's interest payments over time. Interest rate risk is the potential for loss that arises for bond owners from fluctuating interest rates. Credit risk or default risk is the risk that a borrower will default or stop making payments. Liquidity risk is the risk that an asset or security cannot be converted into cash in a timely manner. Some investments, like stocks, can be sold immediately at the current market rate, and others, like houses, are subject to a much higher degree of liquidity risk. Market risk is the term associated with the risk of losing value in an investment because of a decline in the market. Operational risk is another type of risk that deals with the operations of a particular business. If you are invested in the Boston Red Sox, your operational risk might include the chance that starting pitchers and recent acquisitions won't perform, that your manager will turn the clubhouse into a mess, or that ownership will not be able to execute a long-term strategy. Any of these risks might result in decreased revenues from ticket sales. Foreign investment risk involves the risk associated with investments in foreign markets. Model risk involves the chances that past models, which have been used to diversify away risk, will not accurately predict future models. Identify different ways to calculate return. Defining expected return in probability theory. The expected value of a random variable is the weighted average of all possible values. Key points. In order to make investment decisions, investors often estimate the expected return of a potential investment. Expected value is a concept that helps investors assess the value of a potential investment based on different future outcomes and a probability for each outcome. Once you have categories for different scenarios, along with probabilities and returns in each scenario, you then calculate your expected return by multiplying each probability by its respective outcome and adding these all together. Key terms: expected return. The expected return of a potential investment can be computed by computing the product of the probability of a given event and the return in that case and adding together the products in each discrete scenario. Expected value. The expected value of a random variable is the weighted average of all possible values that this random variable can take on. Expected return. Imagine that your friend offered you a chance to play his game of dice. You have to pay $1 to play, and he keeps your money if you roll anything other than a 6. Would you play it? If you answered, "It depends," you are ready to learn about expected value. Care to roll the dice? Is a bet that doesn't always pay out, but pays out big when it does a good bet? Is playing the lottery a good bet? Would it be a good bet if tickets were only $0.10 instead of $1? If your friend told you he would pay you $1 every time you roll a 6, you would be crazy to play. If your friend told you he would pay you $10 every time you roll a 6, you would be crazy not to play. Expected value is calculated by multiplying the probability that something will happen by the resulting outcome if it happens. In the two cases described above, there are 5 ways to lose and only 1 to win. But in scenario 1, you can expect to lose $0.67 or 67% every time you bet, and in scenario 2, you can expect to win $0.83 or 83% with each bet. This is a confusing topic in statistics and finance because on any given roll, there are only 2 outcomes, win or lose, and neither outcome involves $0.67 or $0.83 increments. But to understand expected value, you have to imagine playing a particular game hundreds of times. If you were to sit at your friend's apartment and play the dice game 100 times, imagine what your bottom line would be. Even though you lose most of the time you roll in the second scenario, when you win big. After 100 games, you could expect to be up $0.83 per roll. X 100 rolls equals $83. If you were foolish enough to play the game in the first scenario 100 times, you would expect to be down $67 to your friend. In finance, evaluating your expected return is important, but never as simple as evaluating a game of dice. Imagine that you are going to buy a house a year from today, and you have $20,000 saved for that investment. Because you are smart enough to be using a free online textbook, you are probably savvy enough to know that you can invest the money for a year and get some return on it. You are considering investing that money into stock of a ski/snowboard mountain in Colorado. So you go talk to your snowboarding friend who lives on your floor of the dorm. He tells you that any given winter could be hella gnarly, totally chillax, or wicked bogus, depending on how much it snows. You start doing some research, and you realize that how the stock is performed has everything to do with how much it snows. You create 3 different categories based on snowfall and label them hella gnarly, HG, totally chillax, TC, and wicked bogus, WB. In recent HE winters, those with over 20 feet of annual snowfall, the stock has averaged a 25% annual return. In recent TC winters, those with between 10 feet and 20 feet of snowdrop throughout the season, the stock has averaged 10%. In 2BB winters, those with less than 10 feet of total snowdrop, the stock has averaged 20%. Ok, so now what? Should you buy the stock? If you said, "It depends," that's a good answer. Being as smart as you are, You investigate recent weather patterns, and you decide that there is a 25% chance of an HE year, a 60% chance of a TC year, and only a 15% chance of a WB winter. You understand that past performance is never a guarantee of future results, but still you are happy with your research and you project an expected rate of return for your $20,000. How will it do? Based on your research, you realize that the stock has an expected return that is calculated thus. EER equals probability G X return G plus probability T X return C plus probability to B X return to B equals 0.25, 25% plus 0.60, 10% plus 0.15, 20% equals 6.25% plus 6% plus 3% equals 9.25% if you were to invest the stock in the Ski Mountain year after year, and your research. Key points: any investment should be made taking time considerations and risk tolerance into account. If there is a specific deadline for when the investment needs to be matured, to generate retirement income, pay for a down payment on a house, college tuition, then caution is required. 3 different asset classes, stocks, bonds, money markets, range from aggressive to moderate to conservative. An investment that is aggressive typically features a higher expected return, but also a higher variance. Variance is calculated by calculating an expected return and summing a weighted average of the squared deviations from the mean return. Key terms: variance. In finance, variance is a term used to measure the degree of risk in an investment. It is calculated by finding the average of the squared deviations from the mean rate of return. Standard deviation. The standard deviation of an investment is obtained by taking the square root of the variance. It has a more straightforward meaning than variance. It tells you that in a given year, you can expect an investment's return to be 1 standard deviation above or below the average rate of return. Introducing variance in probability theory and statistics. The variance is a measure of how far a set of numbers is spread out. It is one of several descriptors of a probability distribution, describing how far the numbers lie from the mean. Expected value. Understanding the concept of variance along with 3 typical asset classes, money market, bonds, stocks, can help you build a portfolio for any investor. Money market investments are very safe. They almost never go in the red, but they also don't pay high returns. Stocks are on the opposite end of the spectrum, going back and forth between red and black from year to year frequently, but over longer periods of time they usually pay higher premiums. Bonds are somewhere in the middle. They are safer than a stock, but riskier than a money market, and their average returns reflect that. This table shows how to calculate the variance of an investment outcome. How much do investors want to pay to have to take the good with the bad? Calculating variance is a 3-step process once expected return has been calculated. Calculate deviations from mean. Blue. Square the deviations. Yellow. Multiply the squared deviation by its original probability. Orange. Get brownie points by taking the square root of that number and interpret its meaning in the form of a sentence. You may not need to calculate variance yourself, but you should still notice how we got it. In the figure, we started with 3 scenarios and a probability, P, and return, R, associated with each. We did some math and ended up using the 2 blue columns to get the yellow one. Then we multiplied the 2 yellow columns to get the orange one. We get the variance from adding up the numbers in the orange column. Of the 3 numbers, we add 62, 0.34, and 128. 2 are very big, and 1 is very small. The small number comes from the TC scenario where the stock returns 10%, which is very close to our expectation of 9.25%. The bigger numbers come from winters that are extreme, when the stock performs way above 9.25%, HE, or way below it, WB. The standard deviation can be read as a percentage. It means that Even though we can expect an average of 9.25% return on our stock over the course of 50 years, if we take any given year out and look at its performance, it is likely be somewhere within 13.81% above or below that figure. Variance in relation to expected return. In the discussion of expected return, we concluded that, based on your research, you can expect the ski/snowboard resort in Colorado to have an expected return of 9.25% based on 3 distinct weather outcomes. However, if you invest your $20,000 in that company and expect to have $21,850 after a year, you must remember that this isn't a dice game that you can play over and over again. There will only be one result in this case, and at the end of it, you have to make a down payment on a house. Is this a good investment idea? What if your bid for a house won't be accepted unless you can put at least $20,000 down? There is an 85% chance that the winter is either hella gnarly, HE, or totally chillax, TC, and in either of those cases you will still have over $20,000 to make a down payment. There is also a 15% chance that the year ends up being wicked bogus, WB, and if that is the case you will lose 20% or $4,000 of your initial investment. Now you have $16,000 and suddenly you are thinking Treefort. Let's compare that investment to a CD at a bank that pays 3.25%, no matter how much snow falls this winter. You can have an investment that is federally insured to pay you $20,650 1 year from today, and you can be assured to have enough to make a down payment on your house. If you can let that $20,000 investment sit for 10 years before you need it, there is a much better chance that you will end up in the black, experiencing a profit, than in the red, experiencing a loss. A 30-year-old with a 401k can be much more aggressive in his portfolio than a 65-year-old who will be retiring in 1 year. Every portfolio should be modeled with time frame and risk tolerance considerations. It would be just as foolish for the 65-year-old to be investing in aggressive stocks as it would for the 30-year-old to buy conservative CDs in his retirement account. Identify ways to reduce risk. Defining diversification in general, diversification can reduce risk without negatively impacting expected return. Key points: diversification is not putting all your eggs in one basket. Diversification relies on the lack of a tight positive relationship among the assets' returns and works even when correlations are near zero or somewhat positive. The debate over active vs passive management is one that takes on the limits to diversification. Key terms: unsystematic risk. Unsystematic or diversifiable risk is a term given to the portion of risk in a portfolio that can be diversified away by holding a pool of individual assets. Did your grandmother ever warn you not to put all your eggs in one basket? Did you know what she was talking about? The implication is obvious. If you put all your eggs in one basket and that basket breaks, you are stuck with nothing to fry up into an omelet. Grandma wasn't telling you to grow up and be an omelet chef. She was actually giving you some sage advice that applies to your future as a portfolio manager. We have talked about diversification previously, and this section will follow from that. Remember, we talked about every particular investment having an expected return and a variance. If you are managing a pool of assets, you want to get positive returns without being in danger of losing your shirt. The probability that one stock goes belly up is much higher than the probability that the whole stock market loses value. In finance, unsystematic risk is the term associated with risk that can be diversified away by investing in a broader pool of assets. Diversification relies on the lack of a tight positive relationship among the assets' returns and works even when correlations are near zero or somewhat positive. On the flip side, hedging is the tactic that relies on negative correlations among assets. Diversification comes with a cost associated with it, and some might point out that it is possible to over-diversify. The idea is that you can only diversify away so much risk, that the marginal returns on each new asset are decreasing, and each transaction has a cost in terms of a transaction fee, and also research costs. At some point, it just isn't worth it anymore. The risk that can be diversified away is called unsystematic risk or diversifiable risk. Some investors like to call themselves fans of active or passive management. In fact, two of the biggest mutual fund managers, Fidelity and Vanguard, take opposite stances on this issue and use it as a selling point to customers. Proponents of passive management say the market knows best, and they seek a portfolio that has an underlying pool that mimics a benchmark index. Think S&P 500. Active managers, on the other hand, believe that their fundamental analysis yields them a competitive advantage. They might decide Microsoft stock is underpriced based on changing demographics to the labor supply in Seattle, or they might decide that political stability has improved emerging markets in sub-Saharan Africa, but the yield on their bonds hasn't taken that into account. This debate is all held on the margins. Research has shown that there is a clear advantage in any portfolio to hold at least 30 different positions, an empirical example relating diversification to risk reduction. In 1977, Elton and Gruber worked out an empirical example of the gains from diversification. Their approach was to consider a population of 3,290 securities available for possible inclusion in a portfolio, and to consider the average risk over all possible randomly chosen asset portfolios with equal amounts held in each included asset for various values of n. Their results are summarized in the following table. It can be seen that most of the gains from diversification come for n less than equals 30. Identify ways to reduce risk. Defining systematic risk is intrinsic to the market, and thusly diversification has no effect on its presence in investments. Key points: diversification is a technique for reducing risk that relies on the lack of a tight positive relationship among the returns of various types of assets. The role of diversification is to narrow the range of possible outcomes. Unsystematic risk does not factor into an investment's risk premium, since this type of risk can be diversified away. Key terms: systematic risk. Systematic or non-diversifiable risk is a term given to the portion of risk in a portfolio that cannot be diversified away by holding a pool of individual assets and therefore commands a return in excess of the risk-free rate. Recall that previously we talked about the security market line and the implication that investors require more compensation for extra risk. One might pay the same amount for a safe investment as for an investment carrying more risk. However, the riskier investment will, in theory, provide a higher return. This is the principle behind the security market line. Diversification is a technique for reducing risk that relies on the lack of a tight positive relationship among the returns of various types of assets. Logical investors would agree that diversification helps to minimize the risk of loss. However, diversification is not a guarantee of success and is not without drawbacks. First, non-experienced investors will generally group various companies together for the sake of diversification without performing true due diligence. In addition, a diversified portfolio takes a great deal of time to manage because each additional asset or company must be monitored and potentially swapped out as market conditions change, and the constant micromanagement of the portfolio may lead to additional transaction costs to maintain set risk tolerance levels. By diversifying a portfolio of assets, an investor loses the chance to experience a return associated with having invested solely in a single asset with the highest return. On the other hand, the investor also avoids experiencing a return associated with having invested solely in the asset with the lowest return, sometimes even becoming a negative return. Thus, the role of diversification is to narrow the range of possible outcomes. The security market line. Diversification theory says that the only risk that earns a risk premium is that which can't be diversified away. As a result, the portion of risk that is unsystematic, or risk that can be diversified away, does not require additional compensation in terms of expected return. For example, consider the case of an individual who buys 50 corporate bonds from a single company. The individual receives a certain yield based on the purchase price. However, if unexpected business risks lead to liquidity problems, the company might go bankrupt and default on its loans. In such a case, the investor will lose the entire investment. Conversely, if the investor buys a single bond from 50 different corporations who have similar credit ratings, then one instance of insolvency will have a far less drastic effect on the investor's portfolio. Now, imagine that these 50 corporations are all given a lesser credit rating because of the risk of their overall market segment. In this case, the individual is still at risk to lose some or all of the initial investment. This type of risk cannot be diversified away and is referred to as systematic risk. This is the portion of risk that pays the risk premium, because the risk associated with this particular segment of the market is more tightly linked to the risk of the market as a whole. This risk is present regardless of the amount of diversification undertaken by an investor.